Successful investors know there is just one question to ask before investing in a company. Can I be confident it will give me the return I want? The answer yes is a green light to go ahead. The answer no leads to a second question. What is the maximum price I should pay to be sure I will get my required return? I've devoted 12 years of research and analysis to develop the investment software Conscious Investor to answer these questions. In this video, I briefly describe some of its features and benefits, and how it answers these questions. Conscious Investor is a program enabling you to think like Warren Buffett, to sort through thousands of companies in minutes to find those few select wealth winners you should invest in. The software covers every company on the major stock exchanges in Australia, Canada and the US. You can be sure no opportunities are missed. In this video, I'll use examples from the Australian market. Conscious Investor works in 3 steps: scan or filter individual industries or even the whole market, review the companies passing the filters in more depth, and finally calculate whether their current prices will give you your required return, or if not, what price should you pay. You can scan or filter on individual industries or on the whole market. The filter step uses sliders to quickly change the threshold level or to accept the default levels. But more than just using the standard filters such as debt and return on equity, it has unique proprietary filters including the stability of growth, called Steiger, and the expected return, called STREP-D. We look at the stability of growth in sales and earnings because it gives us more confidence about the future growth of the company. We look at the expected return because this is what we want to know as investors. What return can we confidently expect in the future? The software finds those companies with expected return above your required return. Here we are filtering under current prices. To get a better understanding of the power of Conscious Investor, we'll roll back and filter under 2010 prices. Let's choose the retailing sector. Just 2 companies passed through the default filters using the automatic margin of safety, ARB Corporation and Webjet. How did these companies perform since 2010? Before answering this question, I want to sketch how we use Conscious Investor to analyse companies such as these in more depth to ensure that they have no hidden weaknesses that would cause us to bypass them. One way to look at companies in more depth is via the Conscious Investor wizard. This shows 2 key charts. It also automatically explains in plain English the content of the charts and their significance in considering the company as a future investment. Here we see the results for Woolworths. Another of the key charts is the high-low PE ratio. This chart shows the range of the PE ratio each year for the past 10 years. Even for such a stable, iconic company as Woolworths, there's a large variation on a year-by-year basis. If we like a company, this chart gives us crucial information about what would be a reasonable level for the PE ratio before we would go ahead, and the confidence the buying opportunity will come about. Once the company has passed the filters in Step 1 and a thorough analysis using the charts in Step 2, it's time to implement Step 3 and calculate the expected return. This page may look complicated, but all the numbers and calculations are completed automatically from the database once a company has been selected. For example, here's the data for Woolworths. Step 3 calculates what return can be expected. For example, one company might show the expected average return over the next 5 years is 5%, for another 10%, and for another 15%. In this way, it's easy to see whether to go ahead with a purchase or not. If the expected return is not enough, Conscious Investor also calculates the maximum price to pay to achieve this return. All this can be done under computer-generated margins of safety in the areas of company growth, market opinion, and board dividend policy. This gives even more confidence your investment performance will meet your goals. When to sell can also be calculated. Finally, as promised, I said I would report the returns on the 2 retail companies that passed the filters back in 2010. ARB averaged 34.4% per year for the next 3 years, and Webjet averaged 20.7%. These exceeded the STRET-D or expected return calculations under the margin of safety for these companies of 15.9% and 17.4%. I've tracked the results over the past 12 years using Conscious Investor at the start of each calendar year. The result was an average of 20.2% per year with reinvestment of dividends and before taxes and trading costs. If you'd like to know more about using Conscious Investor to find wealth winners and filter out capital killers, please visit us at teaminvest.com.au for Australian investors, conscious-investor.com for US and Canadian investors, or consciouscapital.com.au for our fund.